So during the week I had a question and answer session on Instagram, answered a number of property related questions, but there was one question in particular that I said that I'd go and make a YouTube video in more detail on the actual question. That question was, what tax benefits are there in buying property? It's a very broad question, so I decided I'd try best answer it on a YouTube video. I'm not going to be able to give all the answers to it within a YouTube video. For anyone that doesn't know me, my name is Shane Fleming. I'm a property consultant based here in Dublin, Ireland. I focus on commercial property and investment property and a little bit of residential property as well. But here comes the disclaimer. I'm not an accountant and I'm not a tax consultant. Even though there are accountants in the family, I'm not one of them. So therefore, anything I say in this video is just a general overview, and if you are buying an investment property, you should seek proper tax advice. To answer the question in a broader approach first, I think the answer would be that there isn't a huge amount of tax benefits for buying an actual property at the moment. There was loads and loads of tax incentives throughout Ireland to buy property, from Section 23s and Section 50s. Some of those were based on kind of redeveloping or regenerating an area. Some were based on providing a certain particular asset type, such as student accommodation. But they got a lot of criticism because they effectively, I think, opposition within governments as well as the press felt that they were a kind of a benefit for wealthy people to get wealthier. And perhaps they were, but they also actually helped a lot of people generate wealth from middle classes and lower classes as well, because it reduced their tax burden if they were buying property. Some actual areas that we all know, and some areas we might love and hate, actually benefited incredibly from actual tax incentives over the years. And one of those areas would actually be Temple Bar. Temple Bar was in rack and ruins, and it needed a massive amount of investment to actually get it to where it is now. And there was a huge amount of tax incentives to actually get people to buy the rundown properties and fix them up. But if those tax incentives never actually were introduced by the government of the day, what would have happened was, or what the plan was actually to bulldoze the entire lot of it and create a bus depot. And I think even if you love or hate Temple Bar now, I think you'll agree that it was a good thing to keep that historical part of the city, and tax incentives helped that to actually happen, rather than actually bulldozing it and creating a bus depot. So that's just one example of tax incentives actually working, but generally speaking they were very successful, but there was a very negative connotation on them because it was felt that they were just incentives for the wealthy. And therefore no government or no major government will actually probably roll out any major tax incentives like we had in the past, because there will be just too much backlash from the opposition as well as from the press as well, in terms of it just being a benefit for the wealthy. However, that being said, I actually do think that some areas of the country and some focused tax incentives could actually benefit our country long term. So generally speaking, at the moment there's no direct incentives to buy property from a tax point of view, but there are taxes. You do need to be aware of the taxes that are out there that affect property. The taxes that affect property are stamp duty, your income tax, and even VAT, as well as capital gains, and you also have your local property tax and your rates on commercial property. So just to quickly explain each one of those, and each one of those will actually have different consequences of how you actually structure a deal as well. So if you're buying property, the first tax you'll have to pay is stamp duty. If you're buying a residential property under $1 million, you'll be paying 1% stamp duty on that $1 million. Anything over $1 million on the residential side is taxed at 2%. On the commercial side, the stamp duty is 7.5%. That also includes development land, even if it is residential development land. Another tax that you'll need to be aware of in terms of when you're buying property is your local property tax on the residential side, and your rates, your local council rates on the commercial side. VAT actually is applicable to some properties in terms of some rates that are collected on some properties. Generally speaking, it only applies to commercial properties, and it is generally up to the landlord to decide if they're going to opt to charge VAT to the tenant or not. So another tax that you'll need to be mindful of in regards to property is capital gains. That is a tax on any profit you've made on the acquisition of a property when you come to sell it. There are ways to minimize your capital gains in terms of any major improvements or any major works that you've actually put into the property can be written off against capital gains, and there's a number of things that can actually help reduce your capital gains when you come to actually sell the property. If you're buying a property for yourself to live in as your family home, generally speaking, capital gains won't apply as long as you haven't been renting it out. But what I think most people are actually quite curious about is the tax on the income, i.e. tax on the rent on an annual basis, and how much tax you'll have to pay on an annual basis. The amount of tax that you will actually have to pay on an annual basis on the rent will actually depend on how you've actually acquired and what legal status you've acquired the property under. Generally speaking, the main legal structures that you'll buy a property under are your personal name, i.e. that's very straightforward, you buy it under your personal name. The next one, most common one, would be buying it in a company, and generally people will call them SPVs because they're special purchase vehicles. The next one will be a pension. They're the three ones I'm going to focus on. There are other ways to buy properties in terms of a unit investment trust or a REIT, but if you're looking to do something like that, generally speaking, there are minimum investment requirements. But if you're actually looking to invest via a unit-based trust or a REIT, and you're looking to set one of them up, realistically, you won't get the information from a YouTube video. You'll have to be engaging a major law firm as well as a major accountancy firm to actually help set up that, and they're major vehicles that need a huge amount of capital behind them before you can actually set one up, and generally speaking they have minimum investment requirements in terms of the actual volume you need to actually set one up. So for the purposes of this video, I'm going to leave those aside because it's not really relevant to most people. You can invest in them directly, but in terms of setting one up, it's generally speaking you need major funds to set one up. So I'm going to focus on buying as an individual, buying as a company or an SPV, and buying within your pension. So first off, we'll look at buying a property as an individual, and again we're looking at buying it as an investment property as an individual, and focusing on the tax issues that you might face as an individual if you buy an investment property. If you're buying a family home for you to live in, of course buying it in your personal name is probably going to be the best route, but this is if it's an investment property and there's going to be income coming from this property. So if you buy it as an individual, any rents that actually come in from the property will be taxed at your marginal rate. So therefore, if you're at the higher band of tax, you will be paying over 50% of the rent in tax. However, most of your annual expenses can be claimed back against your tax liability. So your management fees, letting fees, also service charge, any kind of minor repairs can actually all be claimed back against your tax liability. Any major capital works can be claimed back over a set period of years or claimed back at the end in regards to any capital gains you may have. But again, you do need to talk to a tax consultant on this to make sure you're actually submitting your income report and paying the correct tax on an annual basis. So one item that actually a lot of personal landlords have a bit of a bee in their bonnet is in regards to borrowings and claiming back the cost of borrowing against their tax liability. They can't claim it all back. There's only a certain percentage, I think it's about 85% or something like that, that you can claim back on your interest payments. That changes all the time, and it will depend on your circumstances, and it also depends if you borrowed much money against the property in regards to how much the interest payments are. So that is something that you will need to take tax advice on. The one benefit from buying as an individual is if you are not actually living in Ireland, because your tax liability is capped at 20%, and you can still claim back any expenses you have as well throughout the year. The one thing about that is you'd need to make sure that whatever income you bring back to the country you're living in is there's no tax on that. So you will need to take independent tax advice depending on what country you're living in and what tax rules they actually have in regards to rental income that you're getting from a foreign country. So the next one I'm going to talk about is a company or an SPV, which is a special purchase vehicle. Generally speaking, people set up these SPVs to buy a particular property or buy a handful of property. What you can do with an SPV in terms of your tax is, I suppose actually first of all, your taxes that an SPV are liable for are pretty much the same as an individual will be. So they will be liable for tax on the rent. That will generally be actually capped at 25% on rental income. What happens with that is you still have the ability to claim back any of your expenses. But one major benefit for a company is they can claim back 100% of their borrowing costs. So the main difference for a company versus an individual is an individual could be paying up to a 50% tax on their rent, whereas a company it's capped at 25%. And also the main difference as well is a company can claim back everything that an individual can in regards to their annual expenses, but they can also claim up to 100% of their borrowing costs. So you may look at that and go, well, definitely the option is to buy through a company. However, when you actually want to take the cash yourself into your own personal name, you are taxed again at that point. So there's different routes to take the cash out of the company. It will depend. You could take it out as a dividend and you'll be taxed, I think it's at 33%, or you take it out as an income, and at that stage you will be then taxed at your marginal rate. So therefore, when you look at it like that, there's no major difference between running it as a company or running it as an individual. However, the major difference would be if you have a lump sum that you want to invest into a property. If you put that lump sum as an individual, it's stuck there, it's gone, and any rent that you get in from that point, you will actually just be getting, you'll just be paying your tax on the income. However, if you have a lump sum and you lend that lump sum to this new company you've set up as a director's loan, you can then take the payments back via repayments of the director's loan, and you will only be paying tax on any interest that you've actually earned. So therefore, if you have 300,000 and you lend your company 300,000, you can effectively get a rent for a number of years tax-free back to you before you'll actually have to pay any tax on the actual income that the company is actually making. But again, these are all down to different personal circumstances, and you will have to talk to a tax advisor, and you'll have to make sure you set it up the correct way and you set up the loan the correct way to actually do this. There's no major magic way to get out of tax from a property point of view if you're buying it as a company or as an individual. But that brings me on to my third and kind of final one, is buying it through a pension. So there are ways to set up pension funds that you buy a property directly. Generally speaking, you'll need at least 50% of the cash down on the property, and you will be able to borrow another 50%. The property transaction and everything has to be at arm's length. So you cannot buy a property that you're using for your business, or you cannot buy a property that you're planning to put your daughter or son or niece or nephew in as a rental tenant. You cannot have any direct connection with the actual property. But any rent that you get in from that property to your pension is not taxable. So therefore, if you got 30,000 in on a rental income every year for the next few years, you have paid no tax on that. And the major kind of benefit, if you were to do this at a young age, would be to actually build up a huge portfolio of properties within your pension fund, because effectively they're funding themselves, and every few years you'll have a cash lump sum to be able to go off and buy another property, and you won't be paying any tax on any of it until you draw down the pension when you're in your 60s or 70s. So actually buying a property through a pension fund, a self-administrated pension fund, or a pension fund that you've set up with a broker is actually probably one of the most tax efficient ways to buy property. It is the most tax efficient way to buy a property, and you can actually build up real wealth within your actual portfolio over a number of years because of it. It's effectively what major landlords and investors actually do. Some of the biggest landlords in the city, especially in Dublin, are actually pension funds. The likes of Aviva and iPut are pension funds, and they use this kind of, I wouldn't call it a tax loop, I'd call it the way pensions actually work. They use the mechanism of a pension to actually invest in property. The ability to buy properties via a pension is not the sole benefits of these major companies and major funds. Individuals can do this as long as they have got a bit of a cash reserve to start off with. They can actually buy via their pension. Does mean they're locking that cash away for a number of years until they retire, but it does mean you can build up a fairly substantial portfolio over a course of years. Like if you were to have the guts of 250,000 right now in your 30s and you were to invest it within a pension fund over a number of years, by the time you actually retire, if you kept reinvesting it into property all along the way for the next 20, 25 years or 30 years or longer, by the end of it you could have 5, 6, 7 properties by the end of it, and you'll have only realistically paid for one. I know there's an awful lot in that. I've kind of just gone off very quickly to kind of get as much information as I possibly can. Perhaps I've actually given too much information and it's too broad, but it's generally speaking, in terms of tax, it's a very detailed area. Every property or every investment may be treated differently. You will need to get tax advice all the time if you're investing consistently, and I would recommend that you do get tax advice. I'm not, as I said, not a tax consultant, so this is just my general knowledge of the area. Realistically, what I've given you in this video is probably a lot more questions. As I said, I've raced through this pretty quickly, and I've probably given you more questions than I have given you answers, but I hope I've given you a little bit of flavour of what kind of stuff you should be looking out for in determining what method you're going to actually invest or how you're going to invest. I hope you got some benefit from this video. If you did, give us a thumbs up, and please put any comments below if you have any questions. Also, don't forget to subscribe to the channel. It really helps me out, so if you could hit that subscribe button, it would be great. And as always, thanks for watching, and I will be back next week with another video.